Hello, this is Ernest Burley, your CIA, your cool insurance agent, back at you again with some more great information on insurance. Again, I'm a licensed insurance agent with over 30 years experience in the industry, specializing in all areas of insurance. I have clients all across the country. The purpose of this podcast and the goal of this podcast is to educate, is to enlighten, to empower you to make the right decisions for you and your family with objective and unbiased information. So I'm all about getting the right information to you so you can make the right decision. That's what it's all about. That's it. Let's get at it. Today's podcast is titled Real Estate or Real Mistake. Again, real estate or real mistake. There's a lot of talk about real estate out there, getting rich in real estate and this and that. I just want you to see both sides of the coin and understand the responsibility of owning and investing in real estate, basically. Okay, so I'm going to talk about it from the insurance aspect and also from the property ownership aspect. So real estate versus real mistake. So when I speak about these things, I speak from experience. I don't speak from like I read it in a book or I heard from somebody. I'm talking about real life experience. Either I've experienced or my clients have experienced. I have a large client base. So we deal with a lot of insurance aspects, dealing with property. And I own property myself. I own my own home. I own my office building that my businesses run out of. I own property, real estate, rental property. And also own some farmland. So I own different types of real estate. So I'm not talking from what I heard, I'm talking from what I know. Okay, so here we go. I want to jump right on into it. So is the real estate for you or a real mistake? So here's the first point I want to make, okay? Don't jump in too soon. Don't buy too soon. You want to make sure that you're in a financial position to be able to assume the responsibility of a property owner, because it does cost money to own real estate. You want to be in a good financial position and have your eyes wide open when you talk about buying some property, because there are a lot of things that come with owning real estate. You have the mortgage to pay, and the mortgage normally includes insurance and taxes, right? You have the upkeep of the property. You have, you want to have cash to furnish the property, right? And personalize it if it's a property that you're living in. You also want to maintain and keep intact your emergency savings. So you don't want to go into a property and be what they call house poor. You don't have money to do anything else but pay that mortgage, drive to work, and drive back to that house. You don't want to be in that situation, okay? So make sure we still have some savings off to the side after we purchase the home. In addition to that, we want to be able to continue to save going forward. So you want your financial position to be that you can afford to buy that home, still keep some savings intact, and be able to continue to save going forward. That's what I call being in a good financial position to own real estate, okay? Next, if it's a rental property, you want to make sure you have the right renter's insurance on there, rental property insurance, rental dwelling insurance. Different companies call it different things. So you want to make sure you have the property insured correctly, because some people, they end up renting their home and they buy another home and move into that other home, and they keep a homeowner's policy, a regular homeowner's policy on the rental property. But no, you're supposed to contact your insurance company and let them know, I don't live there anymore. It's a rental property, and that's a totally different type of policy that you would have on that property. So make sure you do that. You have the right insurance on the property. You also want to make sure that your tenants, if it's a rental property, they have insurance. That should be a requirement of the lease, that you make your renters have renter's insurance. So if something unfortunate happens, they have coverage for their own property and also for liability. In addition to them getting that renter's policy, make them add you as an additional insured on that policy, which means you have coverage under their policy for any liability that arises out of their action. Say something happens and you get dragged into the lawsuit because you own the property, then you have coverage under their policy for the liability aspect of that policy. Make sure you have a real tight lease. Make sure you know about the laws of the land, right? So each state is different, as to some states are more tenant friendly, some states are more landlord friendly. So you want to know the lay of the land and know what you're dealing with, because some states are very friendly to tenants and they can stay in your property for an extended period of time without paying rent if they know how to play the system. I had a client that just happened to just recently. That person was in her property, I think, for over a year and didn't pay any rent. So, you don't want to be in a situation like that. So make sure your lease is very good, very tight, and that you know the state laws. And of course, you want to pre-qualify them, right? You want to do a good job of pre-qualifying them. Now, here's another point about owning real estate, and if it's a rental property, you want to make sure you're in a position to pay that mortgage regardless of whether you have a tenant in there. So you don't want that to be a requirement for you to make the mortgage payment. If you don't have a tenant in there, you should be able to comfortably make that mortgage payment, $500 a month, $1,000 a month, or whatever it is. If no tenant is paying it, you should be in a financial position to be able to afford that payment without a tenant. Now, ideally, of course, you want a tenant in that property to pay the rent for you, so you can take that rent and pay your mortgage. They're basically paying your mortgage for you. And then, of course, you want to pad that rent and be able to have some profit come out of that too, and put some off to the side for maintenance. It's going to come down the line. So make sure that you're doing that. Okay, very important. It costs money to own real estate. Let's just understand that. You have wear and tear on the property. You have repairs that need to be made. You have sudden breakdowns that happen for different systems within the property. So just be in a financial position to be able to assume those responsibilities. Okay. Also, real estate is considered an illiquid asset. So once you put your money into the property, it's not like you can just go rip the front door off and cash it in at the bank, or rip some shingles off and cash those in. That money is in the house, okay? So say you put $50,000 or $30,000 down or whatever to buy the home, that money is locked up in the house. And the only way you're going to get the money out of the house is to either sell the house, or you can take a loan against the equity in the home. So you're borrowing your own money, basically, right? So you have to understand that once the money's in the house, is in there. And if you're upside down, which means you owe more on the property than the property is worth, then you don't have any equity in the home. You just have your cash is just sitting in that house, and you're upside down. So let me give you an example. Say, for instance, if the house is worth $150,000, but you owe $200,000 on it, you're $50,000 in the hole, right? So you can't borrow any money against the house because you don't have any equity in the house to borrow against. Right now, when you get on the right side, so now if the property is worth 150 and you only owe 100 on it, then you have $50,000 of equity in the home. Then if you want, you can borrow against that equity. But ideally, hopefully you don't need to do that. But that's a situation where you can pull money out of the house if you need to for some type of situation. So just understand, real estate is an illiquid asset. Your money is tied up into that property after you buy the home. So let's understand that. Okay. Now, do your due diligence. What are the three most important words in real estate? Everyone knows this. Well, most people know it. Location, 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 right? So make sure that when you buy a property, whether it's a home you're going to live in or a home you're going to rent to others, that you buy in a good location. And I'd like to add three more very important words to real estate. In addition to location, 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 I recommend do your research. You need to do due diligence and look at things like, a lot of people don't look at stuff like this, like the infrastructure. So before I buy any real estate, I look at the infrastructure of the county. So I want to know about the road system, the school system. I want to know about the amenities surrounding that property, because I want to know if I'm going to be enjoying that property and the surrounding amenities, if the school system is going to be good for children, whether I have children or not. You want to look future too and say, okay, well, down the line, if I want to sell this property, I want to have a good school system in the area, because that's what people are looking for when they have children, right? You want to look at the plans, the future plans for that community or that county. So contact the county, find out what plans they have for the next 3, 5, 10 years, because a lot of cities and counties, they have plans, what they plan on doing with that community. So if they're planning on building a football stadium in a couple of years or down the line in a couple of months, I don't know, maybe you don't want to be there, right? So just do your due diligence and take a look at that. Look at the crime rate too. So that's something else you want to look at, the crime rate. So you want to look at things that are going to, if you're living there as a homeowner, you're going to have personal enjoyment from those situations, right? So the infrastructure, whether it be the school system, the amenities, the crime rate, the roads, or what have you. So that's your personal enjoyment. If you're renting to others, they're thinking about the same thing. They want enjoyment. They're just renting, right? And then you want to look future and say, okay, down the line, what is my potential resale value of the property based on the amenities in this county, the school system in this county, the infrastructure, and things of that nature, okay? Now, here's another thing we want to talk about when you're talking about property. And this is segueing right into insurance. So we're going to tap on insurance right here. Do not buy any property in a low-lying area, okay? And the reason why you don't want to do that is because low-lying areas are very, very susceptible to water damage, right? So if you're in a low-lying area, water seeks the point of least resistance and gravity takes it downhill. So if you're at the bottom of a hill or below what they call the floodplain level or what have you, then water is more likely to seep into your home, right? You want to buy high, buy at a high level. So it's unlikely that water is going to seep into your home, especially from some situation like that, or flood, be susceptible to flood, quote unquote. So it doesn't have to be a flood. It could just be water seepage, because if water is pooling at your home because it's in a low-lying area, unfortunately, a lot of times water is going to find its way into the home. So don't buy in a low-lying area, please, please, please. And that's for insurance purposes too, because surface water is excluded in all homeowners policies. And I'll have a podcast talking about flood insurance too. So flood insurance, in order for flood insurance to kick in, you have to have a policy, first of all. But then if you have surface water on your premises, the surface water has to be inundating your property and another property, not just your property. So I'll go into more details on that too. That's a big fallacy. A lot of people don't understand flood insurance, but a lot of water seepage that comes into homes, a lot of it is not flood. It's just water seepage, which is specifically excluded in all homeowners policies. Now, here are 4 systems that you want to pay attention to when you're buying a home too. And this kind of ties into insurance also. Real estate or real mistake? Which one are we going to decide here, right? So here are the 4 main systems: your roof, the plumbing system, the electrical system, and the water heater system, okay? So you want to make sure that those are in good working order. And as a matter of fact, when you complete an application for homeowners insurance or rental property insurance on that home, those are going to be questions on the application that the insurance agent is going to ask you, because the insurance company wants to know, okay, how old is that roof? Okay, how old is the plumbing? What's going on with the electrical system? What's the age of the water heater? Because they know those 4 systems can cause major damage in that home. So if they know that and they're thinking that, you should be thinking the same thing, because sometimes it's not going to be something that's covered by the insurance company. So if it's a big loss potentially for an insurance company, that means it's a big loss potentially for you. Okay, so those are some major systems that you want to make sure are in good working order, so you don't have a situation after you buy the home that you have to replace one of those systems. That's not a good situation to be in. Okay, now let's not buy a money pit. Let's not buy a money pit, because real estate can be a money pit. I don't know if anyone's seen that movie, but there's a movie called Money Pit. It's probably 30 years old or more than that, where you just keep dumping money into a property because it keeps having all these problems and problems and problems. And if you do your research, location, 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 and research, 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 diligence, diligence, diligence. I'm going to add another third word to that. You need to make sure that that home is in good working order, so you don't have a money pit that you've assumed. Real estate. Now, real estate also has its upside. So what I'm talking about today is just making sure that you understand both sides of the coin. Real estate has a lot of upsides. I mean, you can build wealth if you buy the proper real estate, or buy real estate in the right location and at the right time and things of that nature. You can also leave a legacy to your family, whether it be children or godchildren or what have you. So you can build a legacy, you can build wealth with real estate for sure, but you just have to do things decently and in order. Do it at the right time when you're financially able to do it, and you've done your proper research and your due diligence. Secure the proper insurance. We talked about that before. And here's a little side note. I'm gonna give you a little side note. Make sure when you're buying real estate, you're assuming more responsibility. And normally you're assuming more debt, because most people don't buy real estate cash. Most people buy and they assume a mortgage. So when you do something like that, ideally you want to increase your life insurance, right? So you want to increase the amount of life insurance you have, so your responsibility, so if you do have that property, something happens to you, your family can still keep it because they have enough life insurance to either pay off the mortgage or company make those mortgage payments every month and continue to build the wealth or build a legacy within the family. So increase your life insurance accordingly based on the different amounts of real estate that you're purchasing. So that just, it only makes sense to do that, right? And I'll talk more about that in another podcast about how much life insurance you should have based on your situation, not a multiple of your income. It's not that. It's based on what your situation is. Each situation is different, and I'll explain to you how to make sure that you are buying the right amount of insurance for yourself and the right type of life insurance for yourself. So that's it for today's podcast. I don't like to have long podcasts, so I just like to hit you with some good information, some good golden nuggets, and then have you have at it. You have the right information to make the right decision, the best decision for you and your family. So just to recap, real estate or real mistake. We want to make sure that we jump into real estate or property ownership when we're financially able to do so. So make sure that you're still able to live your life and not be house poor. You can still save. You still have some savings. You're able to comfortably make the mortgage payment. If it's rental property, you're able to comfortably make that payment, whether a tenant is in there or not. Okay, so make sure you're financially able to do that. Location, location, location. Make sure that we are diligent and making sure that we're buying in the right location, because that's going to have a major effect on the appreciation of the property going forward. Hopefully it does appreciate. You buy, anytime you're buying anything, you want it to appreciate in value, not depreciate in value. Do your research. The home systems, we talked about the various home systems in the property, right? You want to make sure the roof is in good order, the plumbing system, the electrical system, and the water heater system, all of that's in good order, and that you're not going to have a major system problem after you buy the home. You also want to make sure you have the proper insurance on the home, a rental, some places call it a rental dwelling policy. Sometimes call it renters, secure policy. It depends. Each company is different, but a policy that insures a home that you don't live in and you're renting out to others. So make sure you have the right policy on the home, and also increase your life insurance accordingly based on the amount of debt and responsibility that you're continuing to assume. Okay. Those are the main takeaways and a recap for today. I thank you for listening to the podcast. I really appreciate you enjoying. I hope you share the podcast, let other people know about the podcast, and tune in for future podcasts to come. The way you can connect with me is just my full name at Gmail, ernestburleyjr@gmail.com. Very easy, ernestburleyjr@gmail.com. The number to my firm is 301-262-2600. Again, 301-262-2600. I look forward to speaking with you soon, and I look forward to more podcasts to inform, enlighten, and empower you to make the right decisions. Take care. See you next time.